Thank you. Good news, I will not be talking about regulation so much or compliance. I'll try to rather show a little bit the structure and what really makes us fundamentally different in some ways and where we can find common grounds between the two. So I'll show you a little bit how we are on our side, and then I'll leave you with some slides where there's a comparison to how things are for us compared to how things are in Europe as well. So I guess I'll use this. Well, what I'm going to be focusing today really is to make sure that, as I said, we talk about the scale of how big it really is, the mortgage market right now in the US, as well as the structure that we have in place that is fundamentally different from the European, as well as the rate environment we are navigating today in the US. And then I will lead on to the non-bank lender, which is really a new emerging things in our industry in the US, which I know is quite different here, but I believe we're getting there. And then I will leave you with the US versus Europe for you guys to kind of put your own conclusion out of it. So we'll first get into it, and I don't want to drill too much on the numbers, of course, because those are public knowledge for everybody. But fundamentally, this is the largest debt market in the world, second only to US Treasury, which also it is, as we will see it, part of the mortgage too. Now, the whole market itself is based on these 30-year fixed rate, and it's vital, this is very important, and is fundamentally different from the variable interest rates that we do have in the European Union. And I will explain why slowly into it. But all those numbers are really affected by the 30 years fix. Now, when we want to talk about the GSE structure and how the GSE works, we have to mention, first of all, the three big GSE, which is Fannie Mae, Freddie Mae, and Ginnie Mae. Now, previously, if I did this presentation a few years ago, we could have really talked about the difference between Freddie and Fannie. As today, it's very difficult to make a separation between the two. And of course, Ginnie is slightly different. But what they are really is a state-owned enterprise. They do back up the mortgage, the US mortgage, at least the conforming part. Now, in this presentation, I was really going to avoid talking about the non-conforming, as you can see it there, because I felt that probably wasn't the right room to talk about it. But as today, it's increasing the number of non-conforming loans that we have, because a lot of loans and a lot of clients do not fall into the conforming scenario. So even us as a mortgage company, we do start to provide more and more non-conforming loans compared to the past years. Yesterday, I believe Doug, if it's in this room, asked me, what is the real percentage of those non-conforming loans that we see now in the US? And I actually did not know the answer, so I had to really search it and dive deep inside. And now we find about 10%. Problem is, non-conforming means that also the state doesn't require the same due diligence that what requires on the Ginnie or Fannie and whatnot. Simple because they're non-conventional loans, so it could be anything from a jumbo loan, which are larger than the standard conventional, or it could be an investment property. So those are not reported even to the state. That's why it's just quite hard to actually find the real number. I can just say from back in the day when we used to use one of those loans out of 10, today as a company we see about 6 loans out of 10 that are following the non-conforming compared to the past 3 years at least. Now, I also wanted to explain a little bit how this process works. I'm sure some of you are very familiar with it. Some of you probably have to hear it for the first time, so I'll try to simplify as much as possible. The borrower gets a loan. The originator could be two types in the US. It could actually free technically. It could be a bank, it could be a non-bank. Also, the non-bank sells it to a mortgage company, a broker. So there could be three different type of originator. Some lenders do not originate it directly to the client, so they only fund the loans. Then we have the GSE, that of course, as we explained, takes the loan, and then package, pull it together, create a mortgage-backed security, and sell it to the secondary market, as we call it. Now, the investors, the secondary market, acquires it from the MBS fund. Yesterday during the meeting, I kind of made a very simple example for those of you that are absolutely not familiar with how this works. And that's how they taught me when I started, when I was confused about how it works, the securitization part of the loans. And it was very simple, and it's quite childish, but it does the job. And you can imagine if you want to make a juice, you pick a bunch of fruits from different quality, different type. The GSE is the blender. Transforms it, once it's a juice, is the MBS, which is sold to multiple customers. And that's how you securitize, because if there is a bad apple in that bunch, it gets shared by all the people that are drinking the juice. So now you share that risk among thousands and thousands of investors. The problem is when you have a big batch of juice that is bad, now you poison the whole entire global market, as it did happen. Moving on, the agency, well, this is still related to the same things, but I'll go over this pretty quick. The risk that there is for the investor really is two main risks for any investor buying MBS is the prepayment risk, because in the US, any borrowers can repay their loans at any given time. There's no penalty for them to do so, and often in time it does happen. And I won't go into details, but it does penalize also the lenders when that happens. So the lenders put that back on whoever originated the loan. So it's really a domino effect. And also the rates. If the rates shift, so we see a down in the market, the interest rate goes lower, at that point you have thousands, if not millions of borrowers all refinancing at the same time, which create the convexity effect. We even give it a name. But that becomes an issue because now the investor sees something that is supposed to be edging for 2, 3, 4 years, all of a sudden be repaid all at once at the same time, but thousands and thousands of people each. So now, moving forward to something a little different, I want to focus very briefly on the rates. As you all know, the rates has been going through major changes in the US. We were looking at the pre-2022 that was really referring to post-pandemic or mid-pandemic, where interest rate fall at the historic low. At that point, there were millions of people, if pretty much anybody that could, did refinance their property. What happened is that we have about 75%, if I'm correct, more than that, of the entire market was locked in at a 6% or below, 6% to be conserved. What that has created is a major effect on the market, because as right now you have thousands, actually millions of borrowers that are not looking to refinance again, but also they're not looking to move, because for them to move out of their current property will be overall pretty expensive. So they stay in place. And what we have here is of course, sorry, before I move to the next slide, the market has been impacted by this. And as we see here, to have a better graphic, anybody from the 2.69 up, that's where the numbers is that is creating the issue, the lock-in effect, as it's being called. Now, the lenders and everybody in the origination world, when you're over there, what they're doing is praying for, hoping that interest rate will lower. We calculated about 50 basis point lower will unlock about 1 to 2 million household that could be back in the market. And so everybody's hoping for this without really thinking about the repercussion of that. So if you are in the US in the same environment as this as today, everybody will be talking about what rate is going to look like within the next 3 to 6 months. In our outlook, we don't believe they're going to go anywhere below 6% at any point. Of course, we are optimistic they might do that, but as right now, there's no real signal as today that they will, even though there's a change with the Fed and whatnot, but we still believe that they're going to follow the same sort of book and continue as Powell did so far. So now, this is just for you to have it, really. I think I talk about it, but like, this is how the origination works, and the origination can be a little tricky for the Europeans because they do see the difference in here. Of course, the consumer bank, you have it just like here, no difference. And then the big one right now, which account for more than 65%, if I'm not wrong, which are the independent mortgage broker or the lender, which are very similar between each other. I'm not going to get in there because it's very confusing. We are in that space specifically, and sometimes can be very confusing with compliance. And I know it's almost lunchtime, so I don't want to go deep into compliance. But both of them are doing the same job as a bank. Both the lenders, but lending the money, and the mortgage broker acquiring the borrower for the lender. So it's really a mechanism that each one is working for ultimately sell it to the GSE or the independent market if you are non-conforming loan. And then, of course, we have the capital market, which is just like you guys are well aware of this. So I'll skip right through it. Now, the non-banker lender, it's something that I think could be of some interest to this room. And what I was talking earlier, that's our space where we are. We are still under similar regulation than the banking is. The difference is we're not as a federal, so we're not a national association, NA, as you will see most likely when you're looking at a US bank. But what we do have in common is that we are regulated by a state division, which allow us to do a lot of things that a bank does, but not the depository part. So now in this specific moment, you will see how more and more lenders are stepping into this game. Now, this graph might not look like it was really made, but it is truly how it increased over time. This is, unfortunately, you cannot see the numbers, but I believe it was 2002 or 2001 where we started to have a big increase. So there's key player in the market, which we work daily with, and they're competing to each other for a big share of the market. The reason why this has been really helped by it's multiple laws that came into place after 2008. So the banks have started to take a step back in the US on the mortgage origination because it became it was not anymore cost effective. So those independent brokers started to step in. When the independent brokers started to step in, larger lenders started to grow exponentially extremely fast. So you went from a small shop to $1 billion in funding within 2-3 years. Some of those, I mentioned some of the name here. Some of you, of course, probably are not very familiar. Rocket is extremely famous. So if you're in the US, you will see it on the Super Bowl ads and all the other things. They're very peculiar about them is that they do both. So a lot of lenders usually work directly with the mortgage brokers. They do not lend directly to the consumer. Rocket does both. So it competes also with the consumer. And they're very aggressive in their marketing and so on. So they're really acquiring a lot of market space. Now this has triggered a lot of compliance issues. I promise I was not going to talk about compliance, but I would just mention this briefly. Regulators started to look deeper into this and how effective it is to have lenders, which are non-bank, doing the same bank as a bank will do it. So there is a lot of talk. There's going to be more rules coming out. And currently, as I'm here, things are changing because we're getting notified by the regulators that we have to increase liquidity, which comes to the next part of it. Well, this one, I'll just leave it for you guys because I'm sure you all know very well, probably better than I do, the European side, and you can compare it directly with the US that I place here, so we'll move right through it. So the reforms are coming up. So we'll start from the liquidity, which was not the first one, I believe, but the liquidity problem is something that the regulators are trying to impose on us because they do believe that we could, the lender world, the non-bank world could be the next 2008, especially with a lot of product that we've been presenting to our clients. As I mentioned before, the non-conforming, those are the most risky according to the regulator. So they're trying to do everything to squeeze the market as much as possible and bring it back to the regular bank, the commercial bank. Honestly, I can say after 2 months of squeezing, I can say that we started to see the result. A lot of small brokers are closing down. A lot of large, large lenders are starting to emerge with larger one to offset this issue. And we're getting asked by different states every other week to increase our liquidity in order to offset any future market change. So then we have the technology. I'm supposed to be a big fan of this. I'm not, to be honest. I think we rely heavily on AI at this point, and we're starting to rely on things that we shouldn't, that we should have a human eyes, at least reviewing them before we send them out. And a lot of lenders are starting to bypass the human perspective and just go straight to AI. And it's really affecting our business when we rely on the lender to do the loan as fast as possible, because now the lender's not checking. The lender's, in a way, is saving millions by reducing the workforce that they have and rely completely on the AI. So on one hand, it's doing good, but also is making our life much more complicated because it exposes us to multiple violations, which could cost us the business itself. So it's right now it's very hard to pick and choose the lenders you want to work with, as in mortgage space, because you want to make sure they do not fully and only rely on AI, but there's also a human touch in anything that has to do with the underwriting, the processing of the loan, anything related to it. There is somebody actually genuinely looking at it. Now, the GSE reform, this is purely speculation, so please do not, if things don't change, don't put me on this. It's not political, but it's becoming a political thing. We do not know where is this going to go. We don't have, at least till 2 days ago when I create this, we didn't know what will change or how it will change. But there's a lot of talk about changes going to be made, specifically with Freddie and Fannie. And last time there was a talk, CFPB was changed overnight. CFPB is the organ that controls the whole everything related to finance, to make it easier. And they were changed overnight, literally in 2 days. So this is why I thought it was good to have it here. And of course, the last point is the rate normalization. We hope for rate to change, and hopefully they will. We are confident there will be a change, but we don't believe personally, and I can maybe talk for many others, we'll go below the 6% at this point. So I know we have to go, so this I will leave it to you guys for what we talk about it today. And if you have any question, please, if I can answer. Thank you.